Okay, good evening. Tonight is Tuesday, November 27th. And tonight I'm going to talk about valuation, which is not a topic in the textbook, but is based on my own material because that's kind of what I do during the day. So since I thought there's a big gap in the business education on this topic, I thought I would just take one course. And it's not even going to be the full 3 hours tonight. I'm expecting to be done in about 2 hours. We should be done around 8 this evening. So due today is the Go Help a Real Business timesheet. So if you haven't given it to me yet, please do. And next thing is the final exam, Saturday, December 15, 2 to 5 p.m. in Asbury LE 101, which is next to, there's a roundabout that's in that area there. You should know where that is. I got to give you a warning. I have to make the final exam more difficult, a lot more difficult than the midterm, because the grades have been pretty high so far. The average was 80 on the midterm, or 82. And I'm not supposed to have more than a quarter of the class getting A's. So I have to make the final exam a lot tougher. My target is for an average of 60 to 70. But if I overshoot, then what I'll do is I'll curve it back up. But be aware that it's going to be a lot more difficult. So don't think that I'm playing a dirty trick on you. I'm going to surprise you. I'm not surprising you. I'm telling you right up front that I need to make it more difficult, so as to bring back the average around 70 or so. So be aware. Don't think that I'm trying to pull a dirty trick. I'm being very upfront about it. I have to make it a lot more difficult to get to the average that I'm supposed to get to. All the chapters from the course are on it, including what I'm covering tonight. It's 60% multiple choice, 40 questions, a mark and a half, 1.5 marks each. A bit more qualitative questions than quantitative questions in the multiple choice. And then in the written problem, this is all math stuff. So it's pretty much the same structure, the same format that you've seen so far in the course on the quizzes and the midterm. It's just 60% multiple choice, 40% written. The formula sheet is going to be provided just like you had on the midterm on the last page. It's not up on WebCT yet because I haven't finished the final, but as soon as I'm done, I'm going to put it up on. I'm going to put the formula sheet on WebCT. Suggested exercise with the solutions, they're the same as before. So 3 words to do well on the final: study, study, and study. You gotta know how to do stuff. You can't just say, "Oh, the formula sheet's there. I'm just gonna show up at the final exam and just wing it and figure it out from the formulas." If you do that, you'll get slaughtered. You have you'll run out of time, and you need to know how to do stuff. You can't just, wing it, hope to just figure it out from the formulas, because that's not going to work very well for you. The PDF slides, like I'm using tonight, and also the notes, what I write on the blackboard, as usual, all of those things are posted on WebCT. All of the quizzes that I finished this week, or maybe last week, I put up all the solutions to all the quizzes and the midterm, so you can look at those. And I have the original version and the version with solutions. Same thing with a sample final. It's from the second last time I taught this course, which was in last winter term. So you have 2505 W12 final, and there's also 2505 W12 final solutions. So you can look at both of those. So the sample final and the solutions are posted on WebCT. Any questions?
Sample final, is it going to have same level of difficulty as our final?
Our final is going to be a little bit more difficult than that one. Yeah. can't think of anything where it wouldn't be in the slides. Pretty sure I went over everything's in the slides. But some of the questions are pretty difficult. Like you really got to understand the material to do well. Anything else? All right, so tonight I'm going to talk about valuation. So just I'll do a quick intro. Then I'll talk about the main concept in valuation called fair market value, FMV. I'll talk also about the 7 principles of valuation, and last about some methodology, some basic math examples of things that when you look at either the business news or Dragon's Den or something like that, you should be able to understand a little bit better. So I actually have a Dragon's Den clip, which is what motivated me to bring valuation into this course, so that if one of you ever goes on that show, you don't look like an idiot like that guy. So this is the video that motivated me to include a little bit of valuation basics into this course. Mostly because the way that the chapters lined up with the weeks, I had one extra week to either do review or my own stuff. And since if you want to review, you can just go on YouTube and replay everything you want. I figured I would just give you about a half, 2/3 class on some, basic. Obviously, you can do a lot on valuation, but I just want to give you some basic knowledge, and then I'll just put a couple of multiple choice questions. And I think I got one written question on the final. So, how do you become somebody that does valuation? Just like you have chartered accountants, you have chartered business valuators, which is a program I'm going through right now. And there's 4 core courses. The law and taxation one's actually excellent. My first job ever was working at the tax policy branch of the Ministry of Finance. And I took the law and taxation course, and I still learned a couple things. So some great courses. The private company finance is pretty good too. Chartered business valuators are used a lot in court cases, so divorces and stuff like that, or dispute between partners. So 2 of the electives are about litigation support. So about basically testifying in court and backing up your claims and so on. I'm not doing those. I'm doing private company finance and introduction to valuation for financial reporting, which is where in that course is basically the where you learn about the FASB rule for reporting fair value accounting as opposed to historical costs. So that's coming along in the accounting standards. Then you got to do 1,500 hours of business valuation experience, of which business brokerage, which is what I do for a living, counts. So that's easy. And then you got to do an exam, just like you have the UFE for CAs. You got the MEE for CBVs. So that's there's quite a bit of after you do a CA, that's a nice specialization to get. It's like just like becoming a doctor, and then you become you do like hard stuff, or you do like you become a family doctor or whatever. Like you get a specialty. That's a nice specialty to get after a CA. So why would you need a business to be valued? Apart, from going on Dragon's Den and getting your head ripped off. There's many situations where you do need to get a valuation done, and in quite a bit of those, this is not something where the actual business owner can do. It has to be done through a third party in a couple of cases. Income tax transactions. An example would be that if you have a parent that passes on a business to a child, the value that's done at is going to impact stuff like income tax paid, capital gains, stuff like that. So you need to get a business valuation done. Estate planning transactions. So estate freeze is another type of family transaction that happens where if you have a business owner that has common shares into a company, what you do is you freeze that value into preference share, and then you issue a new class of common shares to kids. And so the value that you transfer from the common shares to preferred shares, which were called these freeze shares, you need to figure out what the business is worth. Shareholder agreements and disputes. So examples are in a lot of shareholder agreements where you have two partners, maybe say at 50-50 or maybe a different percentage, there could be a clause in there that says, if one partner wants out, then the other partner is forced to buy his shares at the valuation of the business. Minority shareholder action. This is more where under the Canadian Business Corporations Act, which is the law in Canada that you create a corporation under. There's also the provincial laws, but nowadays most people incorporate a company, federally instead of just a province, so that if the company grows, it's a lot easier. You don't have to go and incorporate it in each province. And it's actually cheaper and easier to do it federally now. So most people do federal incorporation under the CBCA than any other. In that law, there are provisions if minority shareholders are being mistreated. There's different ways. For example, if the business has major change in what it does and things of that nature, a minority shareholder can apply to the court to get their shares bought out at fair market value. And so that's what a valuation is. You've got to figure out what that value is. Business reorganization. It could be, for example, where there's a bankruptcy or close to a bankruptcy and some of the debt is being reorganized into equity. So, what do you value that new equity at? Marital disputes, that's a big one where say you have, a husband and wife and then they split up. And instead of selling the company and then splitting the cash, what you can do is have a valuation of the business, and the one partner that wants to keep it just pays the other one in cash. It's similar to shareholder agreements and shareholder actions. Employee share ownership plans. I did one of those maybe a year ago. There was a company that without going too much detail, I can't tell the company name or the industry, but let's just say there was an owner close to retirement, has a superstar employee. She wanted to stay with the company and become a part owner of the company, and so the guy came to us to figure out what the share price should be that employee would be able to buy equity into the company. Purchase price allocations. This is when one company buys another, and then say you pay $1 million for a company, but then you got to split that between what you're paying for the equipment, what you're paying for goodwill, and what you're paying for the net working capital and so on. Mergers, acquisitions, and divestitures. So that's what I do. The first step when somebody wants to sell a business, they come to Sunbelt and they want to sell their business, the first thing we do is they pay us to do a valuation report. We come up with a price of what the company is worth. We call it the most probable selling price. And then based on that, then say we do an MPSP report and it says 257. Then we might just go to market and ask maybe 295, 300, or 350 for the business, and eventually it settles pretty close to because when you want to sell a business, you got to know what's the price that you're going to ask. So that's one reason why you need a valuation. Expropriation is quite rare. That's when the government takes over something, and we're not a banana republic type of country where the government can just take over people's stuff, without paying them. So expropriation, that's more common in real estate than it is in businesses. So an example, not that recent, but when there was the Mirabel Airport in Montreal and they wanted a bunch of land, so the government went and said, we're going to take your land now, but they don't just take the land, they have to give you some money for it. So you need a valuation to know what the government has to pay. Can't think of a situation that I've seen where you have an expropriation of a business. It happens in third world country where there's like a coup and then the army shows up at your door and say your oil and gas well is ours now and gun in your face, get out. But that's in Canada. That doesn't happen so much. Litigation support, that's really marital disputes and shareholder agreements if it goes to court, and CBCA stuff. It's really related to that. And going public, going private transactions, that's a special type of valuation called a fairness opinion. So for example, if you have shares of a company that are trading on a stock exchange, and then there's a management buyout where the managers of the company, usually with a private equity group, get together and buy all the shares that are out there to take the company back to private. That's an example of a going private transaction. In the Ontario Securities, OSC, Ontario Securities Commission rule, there's a rule that whenever you do a transaction like that, you need to get an independent third-party valuation of what it's being done at to make sure that the price that's being paid for those shares is really a fair price. So this is a mechanism to protect shareholders when, say, there's an IPO where you're going from private to public. So that's an IPO. That's a going public transaction. And a going private transaction is where you are a public company and then somebody usually it's the management with a private investor gets together. Then going private is basically the opposite of an IPO. So whenever one of those transactions get done, one of those deals gets done, you need to get one of these fairness opinions that basically says, whatever price that this deal is being done at is really a fair price for the shareholders and they're not getting ripped off. There's two concepts of market and valuation. Ultimately, the very simple way to say what is something worth, the answer is what somebody's going to pay for it. Right? A house is worth what somebody's going to pay for it. And so as the economy goes up and down, obviously when the economy goes down, there's less people that want to buy houses, they have less money. So what a house is worth is going to go down because what something is worth what somebody paid for it. This is where you actually have a real transaction that happened. This is what we call an open market transaction, where there's an actual sale that happened. But if you look at back there, all the different possibilities of where you would have a valuation happen, a lot of those, the business is not actually getting sold. The business is still going to be owned by the same person, or maybe there's going to be a change in shareholder, but it's not where you have a third party coming in and buying the whole, the whole en bloc, the whole block of shares of the company. So examples of in here where you have this notional market, which is the idea of a notional market is used where value must be determined without exposing the business interest for sale on the open market. In other words, the value is determined in theory. So an example is income tax and estate planning. The business is not actually getting sold. It's getting transferred, say, to a family relative. Another one would be a marital dispute. The business is not actually getting sold. It's just that one partner is getting bought out. And a perfect example is the employee share ownership plan, where the employees are going to be allowed to, say, buy a couple % of the company. Yeah, the business is being sold, just the shares are being sold, but the business as a whole is not actually going through a merger, through a sale process. So in those cases, you use what is called a notional market, which is, as a valuator, you look at if this business was going to be sold, who would buy it, and what would they be willing to pay for it. So that's the difference between open market and notional market. So the key concept in valuation is what's called fair market value. How is fair market value? It's defined as 1, the highest price available. 2, an open and unrestricted market. 3, between informed and prudent parties. 4, acting at arm's length. And 5, under no compulsion to act. So I think it's open and unrestricted market. 1, 2, 3, 4, 5, 6. Yeah. So let's break these different. So there's the 6 components of something that makes it a fair price for a business. Let's talk about what would make a transaction not at fair market value. Acting at arm's length. Arm's length is a concept in business, or I don't know if you would call that accounting or law, where the transaction is being done between 2 people that are not related. So, for example, if your mom sells you her car for $1, that's not at fair market value for the car because it's not under people that are at arm's length. Things that would not be at arm's length, for example, would be between, say, a parent company and a subsidiary company, or between 2 companies that are owned by the same person, or between a parent and a child, or between a brother and a sister, and so on. Where you don't have arm's length, then the price can be whatever you want the price to be. A lot of times there's kind of a sentimental thing inserted in there. Another one is between that says under no compulsion to act. If you have a business seller that has 6 months to live, they might be willing to take half of what it's worth just so that they get the money now. Or if you have a buyer where they really, really want to own that one business, there's a golf course they played on when they were a kid, and now they're older, and they would just really love to own that one golf course. And there's a whole bunch of people that are bidding for that golf course, and then they want it so bad that they pay a lot more than what it's really worth to somebody that would be that would not be under compulsion to act. So you got to look at a lot of these components. So first, the highest price available. A special interest purchaser, that's related to what I talked to last week, where you have mergers and acquisitions. A special interest purchaser is another company that's going to buy this company and have what are the I talked to about last week, which was synergies, where they're able to cut costs because they get one HVAC company buys another HVAC company. So now instead of having two offices, now they just need one. They won't get rid of trucks. They'll still be serving the sum of the 2 customers of the previous if A and B merge together and say A has 10 trucks and B has 5 trucks, then A and B put together are still going to have 15 trucks. They're not going to cut back on the products and the services that they sell to people, but they don't need to both have a CFO. They don't need to both have a secretary and so on. So they're able to cut back a lot on the fixed cost overhead stuff. So sometimes there's other types of synergies. I'm not going to do a rerun of last week, but there's lots of reasons why one company would be interested in buying another for those synergies. So when you look at fair market value, you have to consider those purchasers that would have possible synergy. A closely related concept is highest and best use. Going back to the example of the golf course, if you have a golf course in a city, most of the time a golf course doesn't make that much money because there's lots of costs. Right? You're running a restaurant, which is not a great business. You have, it's like skiing. You're very vulnerable to what if you have a summer where it's raining all the time, your revenue might be cut in half. It's quite expensive to mow lawn every single day. You got a big ground maintenance operation, so you have lots of costs. Golf courses, as a rule, don't make money, or when they make money, they make nowhere near what that amount of land would be worth. So when you look at golf course, what is a golf course worth in the city? Usually, its highest and best use is just to be ripped off, and be turned into a housing development. So that's what we mean by the highest price available. It's not whatever it's used for currently. It's what is the highest price that could be that business or that property could be used for. And so if you have a different use for that business or a different use for that property, where it would give it a higher value than what it's currently being operated as, then that's the higher value that you use. An open and unrestricted market, that has to do with when I talked about the notional market, which is this fake market where you determine the value of something. Well, there has been lots of tax court cases on that if you have, say, a provision in the shareholder agreement where the people that own shares are only allowed to sell shares to other members of the family, but then say that the only other of the family is just this one bum that's got no money, then they would not be able to really buy the business for anything. So when you talk about a notional market, you look at what the market for those shares, you temporarily, in that theoretical notional market, remove restrictions that you have on sale so that the business would be available on the open and unrestricted market. Anybody would be able to buy it. Competitors from the same country, maybe a foreign company, and so on. Between informed and prudent parties, we see that a lot in smaller, little businesses where you have a business owner that doesn't really know what their business is worth, so they might, offer it for a much lower price than they think it's worth. So between informed and prudent parties, you assume that the buyer and seller side of that transaction in the notional market have full information about the industry and so on. And you can't use hindsight. So for example, if say you're selling like a piece of land, and you have a business that owns like a bunch of land, and you have a certain valuations are done as a specific date. You'll see that later. But so there's a valuator that comes up with a value, say, of $500,000. But then 3 years later, there's oil or gold that are found underneath that land. Well, then if things go to court, you can't say, in hindsight, it was worth really $3 million because there was really that gold or that oil there. So you informed and prudent parties, informed as of the information that was available as of the date that you value something. A valuation is at a specific date, just like you have a balance sheet, right? A balance sheet says, as of, the 31st of September, or as of December 31st. Whereas an income statement is over a certain period. So a valuation is very similar to a balance sheet. It's at a specific point in time. Acting at arm's length, I've already talked about that. This is where if you have a transaction that's done at a price that's not based on real commercial terms, where the people that are buying and selling are related somehow, and so they used a different price, then you don't have a real price. Under no compulsion to act, I've already explained that a little bit. If you have a buyer that really wants to buy something and they end up paying a lot more, that's not fair market value. And vice versa, if you have a seller that really wants to sell and they'll take, half of what it's worth, or 20% or 30% less because they want to sell fast, that's not a fair market value. And expressed in money or money's worth, it has to be based on a cash thing, not you'll get paid in apples or something. Like you'll get paid in in the future some amount. You got to basically put it as of cash as of the valuation date. All right, so the first principle, now I'm going to get into what are called the 7 principles of valuation. So there's a couple of principles of how valuations work. So the first one, I just mentioned that 10 seconds ago, is that a value for a company or a piece of real estate is determined at a specific point in time. And it changes over time. It's a function of what's known and the facts at that point in time. So you might have, businesses are in a state of transition because of their business structure, their product lines, management, financing arrangement, economic, industry, and competitive conditions, government thing. Here's a big example. Whenever smoking laws came in to Ontario, and that happens, anywhere that happens, then all of a sudden, the smokers don't go to the restaurants or the bars as much anymore, and the businesses dropped quite a bit. There's a story in that we dealt with was a bar in Cornwall, where after the smoking ban in bars and restaurant came in, the revenues of that bar dropped by half, dropped by 50%. So all of a sudden, the company's worth half of what it was worth before. So if you said what is that bar worth, it would depend on what was the date that you want the value for. And we get that too for some businesses that we sell, where we do a valuation, and then say it's worth $300,000. But then at the same time, we tell the business owner, well, if you can do this, this, and that, like you really want to crank up the revenue and the profit. And then, it's been maybe 6 months, 9 months, 12 months, and, maybe we've gotten an offer and went nowhere, but it's still for sale. And then all of a sudden in the next year, the cash flow is up by 20 or 30%, or, the revenues are up by a lot. Well, whatever price we came up with originally, that's not what the company is worth anymore. So when we have a business for sale, we look at what goes on, because it takes a very long time to sell a business. It's not like selling a house. My neighbor, one day, I get up in the morning and there's a for sale sign, and then I was like, wow, I can't believe this guy's selling his house. Then I came back at night and it said sold. Like it was sold in basically one day. Businesses, it doesn't work like that. Small businesses, which we say value between 0 and 3 million, they take about 3 to 9 months on average to sell. What we call a medium business, 3 million to 50 million, takes about 6 to 24 months, because you need to find the right buyer, the right buyer, and that has the amount of money that you want. So a lawyer can sell their house to an accountant, but you can't have a lawyer buying an accounting practice, or you can't have a dentist buy a construction company. It usually doesn't work that well. But you can have a dentist buy the house of a guy that used to own a construction business. So that's why it takes a lot more time to sell a business than it takes to sell a house, because you have a much smaller pool of buyers. And since the value of a business is based as of the revenue and the profit at a specific point in time, if we take 6 months, 12 months, 24 months to sell something, well, the value of the business is going to change as we're selling it, because originally we might have asked for 300, but all of a sudden the revenues are doing really well, and all of a sudden now the business is really worth 400,000. I talked about hindsight is not available when determining value, and when you do a valuation report, in the cover letter and throughout everything, you basically say, what is the valuation date? And when you write your conclusion, you say, as of that date, this is what the business is worth. It's very important that the value of a company is not kind of a fuzzy concept. It's at a very specific point in time. The second principle, value is prospective, meaning it's not about what the business has done in the past, even though that's kind of an indication of what's going to do in the future. But value is prospective, meaning that when somebody buys a company, they don't buy the profits that the company has made 5 years ago. What they're buying is the profits that the company is going to make from this point going forward. So when we say value is prospective, meaning it's a looking forward concept, it's equivalent to the present value of the future benefits that you're going to get from owning it. The greater the uncertainty, the higher the risk and the lower price or the value would be. Opposite is the lower the uncertainty, the higher the value of a business is going to be. Here's an example. There's a deal that we did where it was a company that paints lines on the road for the Ministry of Transportation. And they bid every 12 years, they bid for contracts, and then they have the contract for 12 years. So somebody bought it at a fairly high multiple because they know it's not like they're going to buy the business, maybe the revenues are going to go up and down next year. They're buying the business and they know for the next 12 years that's what the revenue of the business is going to be. So that has to do, think of what is something worth, right? You estimate the cash flows going forward and then you discount that back to the present. When you're discounting back to the present, you're dividing by a required rate of return. The lower the uncertainty, the lower that rate of return is going to be, and the lower the smaller number that you divide a series of cash flow by, the higher that value is going to be. So, for example, if you have, say, $1 million divided at a 20% rate of return, that's like 500,000 or so. No. You'll see an example in a sec. Next is the market dictates the appropriate rate of return. At any given point in time, the rates of return will change the determination of the value of the business interest. Think of the multiple that you see in stock markets. The PE goes up and down over time. So when the PE of traded stocks is very low, people say stocks are cheap. Right? On a valuation basis, you can buy stocks for a stock in a company for less than what it's really worth. Those are good times to buy stocks when the price to earnings multiples are low. The opposite is what happened with the dot-com when the price multiples went just out of control. They're like 50, 100 times. Think of Facebook. When it went public, it was what, like 50 billion and now, or $35 a share. That was an insane price. It was like the price to earnings multiple was so off the chart. What happened? Boom, it went back down to, and a lot of people are saying, I think around now it's around 15 or 17, but a lot of people saying that it's really worth around 9 or 10. So that was a overvalued stock. But one point about the appropriate rate of return, it changes over time a lot more in the public markets than it does in the private market. Because when I was working at Sunbelt, well, I'm still working, when I was working in the valuation department, one little study that I did is I looked at what the required return was on equity over time. And if you plot that, if you plot the PEs for the stock market over time, they move up and down quite a bit. But when you look at what is the required rate of return for a small business, the kind of high 30s, like 38, 39 to 50 range, it pretty much stays constant over time. Like it changes a lot in the public markets. It doesn't change so much in the small business, because a small business is more risky than a big business. So people look at required rate of returns of 35, 40, 50%. Principle 4, that has to do with barrier to entry. The higher the underlying net tangible asset value base, so think of a company, you'll see in a bit, is composed, when you look at the valuation, it's composed of a couple of components. So you have what are the fixed, the real assets, and then you have a goodwill value on top of that. So if you have, say, a company that does $100,000 in profit, and you put, say, a 5 multiple on that, so you say that somebody would realistically pay, say, $500,000 for that company, but that company has, say, $300,000 of equipment, then what you say is the net tangible asset is $300,000, and then the goodwill is $200,000, and the tangible assets plus the goodwill, which gives you what is called a going concern value, that's what somebody's going to pay for it. So the higher the percentage of the value of a business is real assets, the more it's worth for 2 reasons. The first one is that if you have a business where you're using a lot of equipment, then that creates a very high barrier to entry, because if somebody's going to want to compete with you, they're going to have to buy that equipment. And so by having a higher part of the value of the business being tangible assets, that creates that barrier to entry. What's the lowest barrier to entry? Spas. Right? What does it take to open a spa? You find a place, you rent it out, you buy a couple of scissors and, I don't know, some brushes and some, makeup and whatever, and boom, you're in business. So businesses where you have very low barriers to entry, where it's very easy to start a new business, in those industries you get lots and lots of competition. And so because there's more competition and it's easy for new competition to come in, then a business will be worth less. The other one is that the more tangible assets that you have, then what happens is if the business, if things go wrong, then what you can do is sell the equipment. So take the example of, going back to my example of a company that's worth $500,000. If you have a company that's worth $500,000, but it has $400,000 of equipment, versus a company that is worth $500,000 but only has, say, $10,000 of equipment, the company with $400,000 of equipment is less risky, because if something goes wrong, you can sell most of that equipment and get your money back. And the other reason is that banks will loan against tangible assets, but they won't loan against goodwill. So a company with lots of equipment is easy to go to the bank and get a loan for. A company that's all goodwill, so examples would be things like services business, like accounting firms, law firms, stuff like that. The value is in the people, it's in the customer relationships, it's in what we call goodwill. So a bank can't take over, if the company goes bankrupt, they can't come in and take the employees and sell them off used to other people. That doesn't happen like that. So the higher the percentage of tangible assets versus intangibles like goodwill, the less risky a business is, and therefore what you divide by when you do your cash flow analysis, the rate is smaller, and so the multiple is higher. Now, it's a very important point in this one, and that's if any of you are going to start a business one day, when you look at the present value of the future benefit from a company, there's 2 components: commercial value and non-commercial value. So we talk about commercial. There's 2 types of goodwill in a company. You have the general goodwill, what we call the business goodwill or the transferable goodwill, and then you have the personal goodwill of a company. So an example of a personal goodwill would be, say you have a little grocery store in a neighborhood, and there's a very friendly guy, his name is Joe, everybody in the neighborhood knows him, and even though his prices are a little bit higher, people have been going there for 30, 40 years, they all like Joe, he volunteers and on the Red Cross and this and that, so he's a part of the community and everybody really likes him. And so people go to that store and they pay more. They don't mind paying maybe 5% more or 10% more instead of going to Walmart or Loblaws, because they like Joe. But if Joe sells his little grocery store to somebody else, that value doesn't stay with the business. It's not transferable. So for that, when you look at the goodwill of a business, especially when you have a single owner type of business, you gotta separate what is the actual goodwill of the business itself. So a goodwill of the business itself could be, for example, location, right? It's a great corner. So no matter what you put in there, people are gonna go through there because it's next to the bus stop that everybody takes the bus in the morning and so on. That is sellable. That is commercially transferable to somebody else. But the love that the community has for the business owner and why they go there, when he sells it to somebody else, that is gone. That's not commercially transferable. So there's one lesson in that, which is never, ever, ever, if you start a business, put your name on it. So if I started a business, I would never call it Murphy and Associates. Here's the reason why. Because then the customers identify the value of the business with me personally. They don't identify with the business. And so if you go to sell it to somebody else, you're going to have a much, much lower price. You see that there's a ridiculous company name in Gatineau where it's a guy that owns it, but it's called whatever name and Sons. But I don't want to use the real name, but say Smith and Sons. But the guy is called Murphy something. Well, when that company went to be sold, if it's some specific last name, some specific proper name, you're not really transferring. It's not really commercially transferable goodwill. Yeah. That's nobody walks into Tim Hortons and say I want to see Tim, right? So you don't have. It has grown above, it almost has become a name in itself. That's kind of a special thing, but yeah, when you look at, if you looked at a single store and it was called Tim Hortons and Tim was working there and then he wanted to sell it to somebody and John buys it, then the mistake that you make when you start a company and you put your own name on it is that you end up creating, you want the goodwill to not be directed towards the owner personally, but be directed towards the business as a whole, so that when you want to sell it, because that's the way a business owner gets out, right? If you work, I said that before, if you work for the government and you want to retire, you fill in the form on Friday morning and you're out Friday afternoon. If you own a business and you want to retire, you got to sell it to somebody. And so you want to have the highest possible price. And so you want, when you're building a business, you want to build the value that's independent of the owner so that as the owner, you can sell it to somebody else, and that somebody else is going to be willing to pay a higher price because if you take off, half the value of the business is not gone. So that's why I say never ever start a company where you have your name in the company name. It's a really bad mistake. So hopefully it's something you'll consider. If come up with an original name and then come up with a name that's transferable. So if you sell it to somebody else, it still makes sense for that other person to buy it. The next one, and that explains why private companies are worth a lot less than public companies. The worst thing that happens to me at work is, say I get, a restaurant owner that comes in and they say, what my earnings are say 100,000, and if I look at say McDonald's or some other company restaurant company that's traded on a public stock exchange, say they have a PE at 12. So my business should be worth 1.2 million, right? 12 times 100,000. Doesn't work like that. The reason is liquidity. What is liquidity? It's the ability to sell something quickly, right? To turn something into cash. Think of the balance sheet, right? Current assets are the most liquid parts of the balance sheet because those are the things that you can turn the quickest into cash. right? You can't, you can turn your equipment into your fixed asset into cash, but that takes quite a bit of time. But cash is obviously the most liquid because it's cash. And then you have accounts receivable, they're the second most liquid. And then after that, you have marketable securities, so things like, short-term commercial, notes. Then you have accounts receivable, and then you have inventory. When you look at a business, if you buy shares of McDonald's on one day, and then the next day you don't want it anymore, well, you just go back, call your broker, or do it on your online, on the online site, and just sell it back the next day. And you just pay the commission and the bid-ask spread, which is a pretty small percentage. But if you go and you buy a restaurant, and then after that you decide, oh, I don't want it anymore, it's not liquid, it's not easily resold. So, private companies to begin with are less liquid than public companies. Because public companies, their stock is traded on a stock exchange, so you can just go and sell the stock on the exchange. A private company, there's no market to go and sell it, so it's a lot less liquid. So that's why you have what is called the discount for lack of marketability. Something that's hard to sell is going to be worth a lot less than something that's easy to sell. If I have a piece of paper that I can turn into $1,000 cash tomorrow, it's pretty, that piece of paper is really worth close to $1,000. But if I have a car that, I have to advertise and then get people to come to my house and so on, so that I can get my 1,000, that's, a lot more trouble, that's worth a lot less. So this is the reason why private companies, and especially smaller companies, it's even stronger than that. You can't take the PE of a multi-billion-dollar public company and apply it to the earnings of a little business on a street corner, because the multiples are different. You'll see in a bit after the break where I'll just tell you. Well, when I get to it, you'll see. Okay, the last principle of the 7 principles of valuation is that the value of a minority interest is worth less than the value of a controlling interest when you look at it on a per share basis. Here's the reason. Especially when you're a minority shareholder of a private company, you have almost, you're at the mercy of the controlling shareholder, right? They can decide to pay dividends on the share or not. They can decide to pay themselves a big salary or not. If somebody wants to buy the business for a lot more money than what the shares are worth now, well, they might decide, oh, I really want to keep it. So even though I got a great offer from somebody, I'm not going to sell it, even though the minority shareholders are jumping down like crazy saying, hey, we really want to sell it at that price. So when you're a minority shareholder, especially of private businesses and small private businesses where you don't have very good corporate governance, this is a very risky investment. And so it's worth less. Say I have a company that, going back to my example, I have a company that's worth $500,000. It has 1,000 shares. Well, the person that owns, say, 60, let's make numbers simple. Say I have a company worth $1 million. I have a shareholder that owns 60% of the shares, and I have a shareholder that owns 40% of the shares. Well, the 40% block is not worth $400,000. The reason being that they have no say in what happens with the company. So what you do is you apply what is called a minority discount. So you value the company as a whole, but then if somebody wants to sell just the minority shareholding, because people are not really interested in buying minority parts of companies. Usually when somebody buys a company like a competitor or a bigger company that wants to do a merger, what they really want to buy is control that company and roll it into their operation. So buyers are not really interested in buying minority shareholdings. And so they might pay $600,000 for the 60% of the shares, but they would never pay $400,000 for the 40% minority interest. So what you do is you put what is called a discount, a minority discount. So the 400,000, if the whole business was sold at one time, that minority shareholder might get the 400,000. But if the minority shareholder was trying to sell just their block, their minority block of share, they would never get the pro rata value for it. So you apply a discount, then depending on there's many different ways of looking at discounts. It could be from 10 minus 10 to minus 20 to minus 50%. And so the opposite of the minority discount is the premium for control. When you look at the value of shares on the stock exchange, there's two factors there. They have very high liquidity, but at the same time they have a minority discount. That's why when shares of a company are bought, when you have a merger that's announced, they always say that it's going to be bought for more than what it is. So say you have shares of a company that are currently trading at $20 on an exchange. And then somebody comes in and says, I want to buy this company and I'm going to pay 25 or 29 or 35. The reason why they want to do that, not because they want to be nice to shareholders, because business, there's no sentiment. People are tough. The reason why they're paying that premium is because they want enough people to tender their shares into the merger so that they end up taking control of the company. So that's why you have a premium for control. That's why shares, when you have a merger announcement, we talked about it mathematically last week, but now I'm explaining it why. Why does that premium exist? It's because the buyer, what they really want to do is take over and control that asset. And so they're going to offer more per share so that they end up getting at least 51% of the shares, and they end up controlling that company. Okay, so here's a good place to take a break. Okay, it's 7:20, let's continue. So in the first hour, I talked about valuation in a qualitative way. So now I'm going to start talking about it a little bit more in a quantitative way. So I'll start talking numbers, do a little bit of math, explain to you what if you looked at the video, the Dragon's Den video that I showed you, there's a couple of technical terms in there like multiples and so on, so growth. And so, I don't know, what do those things mean and how are they used in valuation? So when you value something, and that's true either in real estate or in a business, there's three ways. You can come up with three different value for something. A challenge is that a valuation is not a precise accounting number like, how many, how many bars of soap do we have in our store? You can send somebody out to count it. You know how many you have, and it's a very precise number. How much cash do we have in our bank account? Well, the auditor can call up the bank and say, how much does that company have in their bank account? Those are precise, well-known number. The issue with, going towards this fair value accounting that FASB is going to, as opposed to historical cost, both of them have issues. Here's the problem with historical cost. If you have companies that have a very long history, and they've owned some assets for a very long time, then the balance sheet does not reflect the financial position of the company very well. Here's an example. If you have a great example, I know this guy, he's it's the dad of the friend of my wife, and he owns a garage that he bought downtown. But it's like right downtown. It's like north of the 417, and he's got a big piece of land, he's got a garage on it. So he's carrying the land on this balance sheet at, maybe he bought that garage for, I don't know, maybe 50,000, 100,000, 30 years ago. So the value that he carries, say the land on this balance sheet is maybe, 30,000. Well, a couple months ago, he had a developer come into the garage and say, I'll give you $2 million for that piece of land. So when you look at the balance sheet of that company, where land is carried on a balance sheet as at historical cost. So you buy a piece of land, if you hold on to it for a very long time, and it does go up in value, because think of it, what is the one asset on earth that has a fixed number that's never going to go up ever? There's only so many square kilometers that the earth has, but then there's always a higher and higher demand. Fixed supply for eternity, higher and higher demand. What happens to prices? Over time, land always goes up in value. You might have these, down markets and so on, but over very long periods of time, land always goes up in value, and sometimes quite a bit. So the classical gap ways of carrying land on a balance sheet is what price you paid for it. Well, you might have bought that land 20 or 30 years ago. So going back to my garage example, the guy's carrying that land on his balance sheet at $30,000. But what is the fair market value of that land? What would somebody pay today, the highest price that they would pay and so on, the fair market value definition? It's $2 million. So you can see that the balance sheet does not accurately reflect the financial position of the company because it's carrying an asset at $30,000. That's really worth $2 million. So other examples are things like investments and so on. This whole mark-to-market thing for financial instruments. So for the accountants here in the class, in the past, things on the balance sheet are what's called historical cost. So what you bought it, maybe 10 or 20 years ago, and then with depreciation. But today, if you're going to sell it, sell one of those assets. That's not what it's worth. So a lot of new standards that are going to slowly come out. I'm reading some books on that, a book on that topic right now. But what the FASB, which is what the Financial Accountability or Financial Accounting Standards Board, so they're the people that come up with the standards of how things should be accounted for. They're going from this historical cost accounting to this fair value accounting where on your balance sheet you carry assets at what their fair market value is today. So for example, if you're a bank and you have mortgages against, say 10,000 homes, but you're a bank in the US and the price of homes has gone down by half, well, you shouldn't be carrying on your balance sheet, that asset at what the original price is, because there's no way you could go and sell it at that price. So what FASB is doing right now is they're going forward with going to this concept of fair market value accounting. What is that going to do? It means that once a year, a company has to value, say you have a parent company and it has different businesses, instead of just carrying it on the balance sheet at what historically they paid for that company, they have to once a year come up with what is the valuation of that business, and if it's gone up and down, that difference in valuation flows to the income statement for quarter to quarter or year to year. Obviously, companies are going to fight that because that's going to put a lot more volatility in the earnings, but the earnings are going to be more volatile, and there's going to be a measure of error because, like I said, valuations are never an exact number, but they will be a better reflection of what the actual position of the company is at a specific point in time. Why do you have why is valuation not, that business is worth $523,657. Why is that not the case? Because there's different ways to look at what is something worth. When I said the most basic way is something is worth what somebody is willing to pay for it, or what somebody has recently paid for it. That is what's called the market approach. And that's the highest, FASB has this level 1, level 2, level 3, where level 1 is the most precise and level 2 is less precise, level 3 is the least precise. The market approach is considered by FASB as the most precise way of valuing something. Because if somebody in a market bought or sold a similar asset, then that gives you a pretty good measure of what it's worth, where you had a real transaction that was done between arm's length parties and all that stuff, in terms of cash, not in terms of, I'll trade you my house for my RV kind of thing. Like it actually was done in terms of cash. Then that's a very good measure of what something is worth. But you don't always have good comparables for something. If you're selling, in my case, where sometimes we sell some pretty unique businesses, where there's only one in the city or very few in the country, and they don't transact very often, it's pretty hard to come up with a comparable. So you look at the other two approach. The first one is the cost approach, and the other one is the income approach. Well, if I look at the three approaches, the best example I could give you is if I was going to value a piece of real estate, say a house. You can value a house these three different ways. The cost approach is, well, what would it cost me to buy a piece of land that same size and build a house? Like, how much would I have to pay a carpenter, an electrician, a plumber, a roofer, and all that to rebuild a house that's exactly like that one? That's the cost approach for valuation. What is the income approach? Well, there's a house there. What could I rent it at? Say I could rent it for, I don't know, $10,000 a year. Then I put, say, like a 5 multiple on that. Well, okay, that house is worth $50,000. The last one is the market approach, and that's really, when it comes to a single family house, that's mostly what real estate agents do. So what they do is they look at, well, say in the last year or the last 2 or 3 years, what have houses on that street or in that neighborhood sold for? And then, well, maybe that house is bigger, and so you adjust up and down in terms of a percentage. Maybe you had, say, a house for, 1,000 square feet that sold for $100,000. Then you would say, well, then the house for 2,000 square feet would sell for $200,000. It's not, exactly one-to-one, because you got to adjust. Some houses have more land, they have, nicer kitchen and so on. But real estate agents mostly use, when it comes to single family houses, they mostly look at the market approach. So they take comparables, and that's one market where it's easy to use the market approach because houses sell all the time. The data is available. In a lot of business transactions, especially private to private transactions, at Sunbelt we get 31 offices in Canada and like 200 in the States, so we got quite a bit of data. But if most businesses, unless you're a public company and it's buying another public company, nobody can know what the actual deal was done at and for what. But when it comes to houses, there's a database, right? Because when you sell a house, you gotta transfer the ownership at City Hall, and so you gotta say how much you paid for, and then the land transfer tax are based on that. So there's very good databases of comparables for houses, and so you can base it on that. If you're, say, instead selling a 10-unit apartment building, well, those don't sell every day, right? There's a lot less of them, and they don't tend to be purchased and sold all the time. So how would you look at something like that? You would take the total of the rents for the place minus what the expenses that you have. So maybe you got to pay, a super. Maybe you have to pay, the property taxes and so on. You come up with what is my net profit or my net rent, and then you put a multiple on that. So typically, residential multifamily will be maybe a 10 multiple, and a commercial real estate, say things like malls or office buildings, they're sold at a bit higher multiple because typically businesses, when they sign leases, they don't sign a lease every year. Usually when a business signs a lease for somewhere, they sign a lease for 3 years, 5 years, 10 years. I've even seen leases for 20 years. And so if you buy, as an investor, if you buy a commercial real estate property, it's a lot less risky because your tenants are legally committed to much longer periods of time. If you buy an apartment building, next to Carleton, every year you got to find new students. So there's quite a bit of risk that you might not be able to rent your whole building in a certain year. So because there's higher risks in residential multifamily, you'll get a lower multiple than you would get in commercial real estate. Let me just one more thing about this. When you look at it from the point of how you would value a business, a cost approach is what we call the cost to create or cost to recreate. Now, most restaurants actually get sold based on the cost to create because most of them don't make that much money. So when somebody buys a restaurant, most of the time what they're doing is they're not buying the restaurant that's in there now. They just want to have, some new concept, and it's a lot easier to buy a restaurant that's already running, that's got, all the equipment there, that has, the kitchen already built, all this, the fire extinguishers, the fire suppression system installed and inspected, and the permits and the alcohol, the booze license and so on. It's very hard to build a restaurant from scratch, right? Because you got to find a space, you got to lease it, you got to buy a whole bunch of equipment, you got to build a kitchen, you got to get the permits, and getting permits and doing things like that, like government things, is really slow. So a lot of times what somebody that wants to open a restaurant or maybe expand an existing chain, instead of going out and finding a new location and buying new equipment and so on, it's a lot cheaper to just buy a failed restaurant and then just take off the sign and put the new sign and change the concept. So that's why when we look at restaurants, there's a lot of times they're based on, because the alternative that a buyer has is they could buy that restaurant or they could build a new one. So a restaurant is usually worth what its equipment and its leasehold improvements are. The income approach from a business, discounted cash flow. This is chapter 10 that we've done, right? You look at what are the cash flows over, say, the next 3 years and the next 5 years. So you estimate, a forward prediction period. So you get, what the net cash flow for the business is going to be each year. Plus, the business is also worth, plus the cash flow of, at the end of the period, say the business is going to be doing that much profit, and so it's going to be worth that much, and I'm going to sell it. And for the people that are going to do the fund that's brought in that, or just any kind of security, public stock analysis, that discounted cash flow stuff is what you're doing all day long. You got different assumptions on the different price, the different costs that are going in the business, and what the multiple is going to be worth like 5 years from now. And so that's a way that the income approach is how most public companies are valued, or at least that's what stock analysts do all day long. They have Excel spreadsheets with big discounted cash flow models, and they have, if you look at an airline and one analyst thinks that the price of oil is going to be something like that, they plug that in and they come up with a value. And that's how analysts come up with their price targets and all and so on. It's based on discounted cash flow. Apartment building, I've already explained to you. Market approach, you come up with the comparables, and I have some examples of that coming up. So let's look at what are the different, you've heard that expression, rates and multiples. What do they actually mean? Well, a capitalization rate is applied to a constant or uniform amount of earnings expected to be earned into the future. So you'll hear, especially the shorthand cap rate, you hear that a lot in real estate. And what that is, think of, this is chapter 8 stuff, right? What is the value of the stock? The constant growth model. The price of the stock today, P0, is the dividend for the next year, D1, divided by the required rate of return minus the growth. So what Kevin O'Leary was talking about when he said, I'm not going to pay a 20 multiple for a business that's not growing. What does that mean? A multiple is the opposite of a rate, right? if you take D1 and you divide, say, by a 20% cap rate, then 1 divided by 0.2 is really 5. So dividing by a 20% cap rate is the same thing as saying 5 times that income. Think of it, in the case of a stock, the income is the dividend. In the case of a business, it's the net cash flow that the business is generating. So to get from what the income of that asset is to what the asset is worth, you can do 2 things. You can divide by a percentage rate, which is that cap rate, or you can multiply by a multiple. So you look at the bottom, one is the inverse of the other. Obviously, if you have a 10% rate, if you divide by 0.1, that's the same as multiplying by 10. So in that case, a 10% cap rate is the same as a 10 multiple. If you have a 5% cap rate, that's the same as a 20 times multiple. So if I have, say, $1 million, I have like a huge building, commercial building, maybe like a 40-story office building. I got lots of tenants, and the total rent that those tenants are paying is, say, $1 million. After expenses, my net profit in that building is $1 million a year. If I say that that building was sold at a 5% cap rate, then what I'm saying is you take 1 million and you divide it by 0.05, which is really the same as 1 million and multiplying by 20. So if I say that I have an investment that has an annual income of 1 million, and I capitalize that income, so in other words, what I'm doing is I'm taking that income and turning it into what its capital value is, well, I can either divide by 5% and I get to 20 million, or I can multiply by 20 and I get to 20 million. That's what I mean by a rate is the inverse of a multiple. Now, think about what's going on with bonds right now and compare that to PEs of stock. If I have a stock that, say, is trading at a 10 times PE, what I'm saying is it's going to take me 10 years to earn back my investment. So that's a 10 times multiple. What are right now bonds, especially the US bonds, trading at? 2%. That's a 50 times multiple. So people think right now owning bonds is a low risk investment, and they are very wrong. Buying bonds right now at such low yields, if you buy a bond at 2%, your payback is 50 years. That's a really high risk. It's almost now that what's happened is people were so scared from the crash in stock prices that they all went into bonds, and that drove the price up, the yields down. So what you have now is a bubble in bonds, the same way you had a bubble in .com stocks before. Bonds are way overpriced. The yields are way too low for what they should be. Mostly because the U.S. government, the Federal Reserve is trying to keep interest down. They're manipulating the market. You don't have a real rate there. When you're buying a bond at a 2% interest rate, that's a 50 times multiple. Nobody would buy a stock at a 50 times multiple. Or the people that did, look at .com or Facebook. They didn't do so well. So understand that the rate is the opposite of multiple. So let's go back to what did Kevin O'Leary was saying when he said, I'm not going to pay 20 times for a business that's not growing. If you have something that's growing faster, then it reduces the cap rate and it increases the multiple. Say I have something that is growing at one. Say I have the required rate of return on a certain industry is 11%, and you have a company that's growing at 1%. So your cap rate would be 10%. So the company is worth 10 times what it paid in dividends in the last year. Well, if that dividend is growing at, 6% a year instead of 1% a year, then the cap rate would be 11 minus 6 would be 5%. So all of a sudden, if you have a business that's growing its if that has a required rate of return of 11%, and it's growing at 6% a year, its profit, not its revenue, then that's how you get to a 20 multiple. That's why the higher the growth is, think of it, because you have a fraction and you have a minus there, it might be a little bit confusing, but think of it this way. The higher that G is there, the lower the number in the bottom of the fraction is going to be, and the smaller that number that when you divide by, the higher the final fraction is going to be. So if G goes up, then the cap rate goes down, and the total value of that stock goes up. So that's what he meant by, I'm not paying 20 times for something that's not growing, meaning that he's paying a much higher, way too high a cap rate that doesn't have growth in it. So what are some commonly used multiples that you see? The one that you should be most familiar with, that you would have seen in the past, is the price to earnings ratio. Right? You just take what is the price of a stock currently trading at, and you divide it. What is the there's two types of PEs. There's what's called the trailing PE and the forward PE. The trailing PE is the current price of the stock divided by the earnings for the last 4 quarters. The forward PE is the current price of the stock divided by what are the forecasts for the next 4 quarters. So you have different rules, and in general, when PE ratios in the stock market get low, that's a great time to buy, because what you're, in a sense, what you're doing is you're buying earnings at a cheaper price. Right? When price to earnings ratios are very, very high, then usually that's a sign of the top of a market. Because the higher the price to earnings ratio is, the riskier something is, and the more highly valued it is, usually compared to what its long-term average is going to be. So when you get PEs that for publicly traded companies that get over 20, 25, 30, 50, 100, usually that never ends very well. So you see that a lot in PE ratios. You see that. That's a measure, that's a multiple evaluation that you see for public stocks. The other one, and that's more what mergers and acquisitions are done of bigger companies. I'm not talking about little dinky businesses like I deal with. I'm talking about big, either big private businesses or one public company buying another public company. They use what's called the enterprise value to EBITDA ratio. What is enterprise value? You should know this by now in this course. It's the total market value of the equity plus the total market value of the debt. And EBITDA is the earnings before interest, taxes, depreciation, and amortization. It's the best measure of a company's cash flow, because you take out depreciation and amortization, which don't affect cash. You take out taxes because depending on the acquirer, they might have a different tax rate. And you take out interest because you want the cash flow of the company independent of how it's financed. Is it a highly leveraged, lots of debt company, a little bit of equity, or is it a company that's mostly financed with equity and just a little bit of debt? You want a measure of equity that's independent of the capital structure. And that's how much debt and how much equity is in the company. And that's what EBITDA is. Price to sales. Okay, most small businesses are based on price to what we call SDE, seller's discretionary earning. I'm not covering that in this course. It's a similar concept to EBITDA, but that's used in valuing small companies. Basically, what it is, it's the EBITDA of the company, but after you take out what the salary of the owner is. Because when you have a big business and you have many shareholders, you look at EBITDA as what the shareholders are earning on their investment. But when you have a small business, really, what is the owner earning in terms of the business? They're earning what the profit of the company is, but also what the salary that they paid themselves. Right? A lot of times we say that people buy small businesses, they're buying a job, right? We had this example of one guy a couple years ago where he was a lawyer for the government. I can't think of a more boring thing to do with my life. What did he do? He bought a little pool hall, right? And he loves it. He bought a job. He bought a lifestyle. So in small companies, we do price to this thing called SDE, which is kind of like EBITDA, but it's a measure of cash flow that's used in small businesses. The other one is price to sales. So if you consider, here's the reason why we look at SDE in a small business. Because if you're a small business owner, you can pay yourself in many different ways. You can either pay yourself a big salary, and then there's not a lot of dividends, or you can pay yourself no salary, and then you pay yourself all in dividends, or you can pay yourself in other ways, in what we call discretionary expenses, right? So you own a retail store in a mall, but you got a Mercedes, and the wife has a Mercedes, and I think the coolest one I ever saw was a guy owned a restaurant. He had 5 kids, but he put his grocery bill for home that he bought at Costco, he put it through the restaurant. So that was a way that he was flowing money from the restaurant to him personally. He wasn't paying himself a salary, or he was paying himself a dividend. So what we do when we look at the value of a small business is we separate all these different flows to the owner, because owners are very creative on how they pay themselves. For example, for me, my old corporation was paying me $10,000 a year for the office in my basement. There's no way I could ever rent the basement for $10,000 a year. That's how I was flowing the money to myself. So this price to SDE, which is the profit to the owner, including their salary, however they want to pay themselves, a small business is worth roughly 2 to 3 times that amount. And a medium-sized business is where it's about 3 to 5 times its EBITDA. You're talking about private. Price to sales multiple instead are used a lot in restaurants, because the idea is this. When you have somebody that owns a restaurant, and a lot of times the ones that are selling restaurants, they're people that had no business owning a restaurant in the first place. So they just blow their brains out. Their expenses are way too high. They're not able to control. There's a really funny saying that in bars and restaurants there's 2 types of bartenders. Those who steal, bartenders who steal, and the other types of bartenders are the bartenders that steal a lot. So in a restaurant, it's very hard to control costs. You end up paying too much for rent. There's very unscrupulous landlord around every town where somebody's got the big dream, they're going to open this restaurant, it's going to make all this money, and they go and they sign a lease for like $100,000 a year, because who cares if I'm paying $100,000 in rent, because I'm going to make $1 million in sales. And then all of a sudden you don't have, you're not doing too well, you're not very efficient in how you control costs, how you're buying your food, different things like that. So in restaurants, it's one of the rare industries where they're priced on a multiple of sales instead of multiple of cash flow. And that multiple is about 25% to 35%. So if you have a restaurant with $1 million in sales and revenue, not in profit, that restaurant's worth about $250,000 to $350,000. What somebody's really going to pay for them. The reason being that a professional restaurant buyer, somebody that really knows, that buys restaurant and that really knows the industry, they don't care what the owner is currently doing, because they know that once they buy it, they'll be able to do a lot better with the expenses. So what they're really buying is the goodwill allocation. What they're really buying in a restaurant is not how efficient the operation of the restaurant is. What they're buying is what is the revenue that restaurant brings in, because they know that once they buy it, they can do a lot better by cutting the expenses and running the thing a lot better. The other area where price to sales multiple are used is Dragon's Den, because a lot of times there's just not a very good measure of profit. So, but most of the time in the Pitches and Dragons Den, you can see, you know what the revenue is. They don't have a very good idea of what the actual profit is. Are you paying yourself, or are you not, this and that. So they tend to price it more as a multiple of price to sales. There's a rare multiple, which is the price to book, and that's more used in banks. And so banks have assets which are loans on their book. So usually you should have roughly, a bank should roughly sell for what its assets are. But when banks are not doing too well, you have these great deals where banks are going to sell at 70% a book or 80% a book. That's a measure of relative undervaluation for a bank. Or the other way is if a bank sells for 2-3 times book, you know that the buyer really want to buy at that bank. They probably overpaid. So this is an example of enterprise value to EBITDA ratios, or multiples, sorry. I forgot to put it on there, but the source is The Economist. There was an article a couple months ago. So those are private equity buyouts of different companies. So you might recognize a few of them there. RGR Nabisco is a big food company. They make like crackers, stuff like that. TXU is, I guess, an oil and gas. Kinder Morgan is a pipeline company in the U.S. Caesars is a casino. Well, not just in Vegas, but I think they have casinos in Asia somewhere, like Macau. Hilton, that's the chain of hotels. You should know that one. Clear Channel is a company that owns radio stations across the U.S. and so on. So these Hertz, car rental, you've probably seen that one also. VNU, Nielsen, the people that make the television's ratings. So if you look, this is the enterprise value that the deal was done at. So this is not, say if I take Hilton, $26.2 billion. That's not what somebody didn't pay $26.2 billion for the shares of that company. It's the shares of the company that they were buying plus the debt that they were taking on. That total was $26.2 billion. Now, at the time, the EBITDA of Hilton was $1.7 billion, meaning that the multiple of EBITDA that deal was done at was 15. So you just take 26.2 divided by 1.7. So there you get a multiple of EBITDA. And I was surprised when I actually ran those numbers. They were pretty high because I'm used to, I deal with small businesses, which are priced to SDE, and I deal with medium businesses, which are a multiple of EBITDA. But the multiples of EBITDA that we see for private, medium-sized private companies are like 3 to 5. But some of these were done at some pretty high. Most of them are above 10. I was surprised how high that was. So that's the enterprise value to EBITDA. So say you were valuing. So if you look at Hertz, that was in 2005. If you want to know, say what is what's another one? Budget worth, and say they had EBITDA of $2 billion, around that time, because these multiples change over time. Say in 2006, in early 2006, I was a valuator and I want to know what is budget worth. And if their EBITDA was $2 billion for the last 12 months, then I would look at a similar transaction, or sometimes in an industry you have multiple transactions, and you have a multiple of 6. And so say if I had budget was doing $1 billion in EBITDA, then it would be worth $6 billion. If it was doing $2 billion in EBITDA, then it would be worth $12 billion, and so on. So this is what you call comparables. You look at past transactions where you actually know the price, and then you come up with a multiple on something, EBITDA or sales or something like that, and then you multiply on what the company that you're valuing is, and that's how you come up for what that company should sell at. What is it worth? Let's do an example. So if I have 3 companies, one of it, so this is an example of price to sales, but it could be EBITDA, it could be something else. So if I had a company that sold for $300,000 and it had sales of 500, so that's the price that it sold for, the whole business, what its sales were, and so you get a price to sales multiple. So Acme was 300K, its sales were 500K, so that's a 0.6 multiple of sales. Great Factory had 2 million, sold for 2 million. Its revenues were 4 million, so that was a 0.5, so 50% of revenues. And in general, just be aware that in general, a company is never worth more than its revenue. In very rare cases will you see deals where a company gets bought for 2 times sales or 3 times sales. Most companies are worth, well, if you take the small and medium businesses that I deal with, and if you take all the deals that Sunbelt has done over the last 10 years in Canada and the US, the overall average is 51%. So a good rule of thumb for small and medium companies is you take whatever the revenue is, you divide that by half, and that gives you what a company is worth. So if you have a company that's doing $1 million in sales per year, that company is worth about $500,000. Here's the problem. People go on Dragon's Den, they're like, oh, I have $100,000 of sales, and my business is worth $1 million. You just get laughed at. Right? A business is not worth 10 times its sales. A business is not worth 25 times its profit, unless it found a way to turn water into gold or something like that. There's businesses in general, and that's a very strong rule of thumb. If you start up a business and you go see an investor and you're asking for a valuation that's more than your current sales, you're probably going to get laughed out of the room. Or they're just going to look at you like, this guy's an idiot. There's no way I'm going to want to invest in him because they have such a distorted view of reality. I don't want to, deal with a person like that every day. So if you start a company, if you go see investors, you got to have a realistic value of what your business. Your business might be worth $1 million 5 years from now, but remember, a business's worth is specific at a point in time. So I've seen on Dragon's Den where it says, well, I want $1 million because we're gonna do $1 million 5 years from now. Well, yeah, the company might be worth $1 million 5 years from now, but that's why you've heard, he's not on that show anymore, but Robert Erjavec keeps saying, your business is not worth that today. He always emphasized that specific point in time. Because if you think from the point of view of an investor, they don't want to pay what the business is going to be worth 5 years from now. They want to pay what the business is worth today and ride along with you up to that value. So they want to invest, buy low, sell high, the classic thing in finance. They don't want to invest at a valuation of $1 million when that's what the company is going to be worth 5 years from now. Today it might be worth $100,000 or $50,000. So they want to buy at $100,000 and ride the wave with you up to $1 million. So that's why, just remember that rule. Very rarely is a business worth more than 1 times its revenue. It's 1 in 100 or something like that, where you'll see a deal done at 2 or 3 times. And that's usually where you have a little company that has an amazing technology and you got a big company that's buying them out. So it could be like a little biotech company that found a cure to cancer, a specific cancer, and they got a pill, and Pfizer comes in and buys them at 2, 3, 4 times revenue. But in general, there's a very, very strong brick wall at 1 time sales. Investors, business buyers never ever pay more than 1 times revenue. So if you want to know what your business is worth, take what your revenue for the last 12 months was, and that gives you a ceiling on what it's worth. So it's worth a little bit less. Yeah.
What's a good multiple of revenues or profit for public companies?
Sometimes they go a little bit above that, but not very. It depends on the industry. I mean, there's some industries that are at 20, 30 PEs. There's some industries that are at 5, 6 PEs. The answer to your question is it depends on the industry in a big way. It depends on how risky an industry is. Obviously, you're going to have much higher multiples in high growth companies because of what I was explaining earlier. But that's such a broad question, it's impossible to give a precise answer to. Okay, so if I keep going here, the General Steel was sold for $750,000, and it has $1 million in revenue, meaning that its price to sales multiple is 7.75. So if I want to know what is the price to sales multiple, so the little hat there, it's a stats thing for an estimate of something. So the estimate of the price to sales multiple is going to be the average. So if you want to know, so the multiple is, well, 6.2 or 6.1, 6.7, just round it out to 6.2. If you want to know, in this industry, if you have a company that has sales of 850,000, how much is that business worth? So you take that metric and you multiply it by the multiple. So my estimate of what the price to sales multiple for companies in that industry is 0.62. And then the company that I'm trying to value has sales of 850,000. And so that business would be worth 527,000. Now, when you look at businesses, there's two ways to value them. There's what's called the levered approach and the unlevered approach. So the levered approach is where the debt is included in it. This is a multiple where it's dependent on what the capital structure of a company is. So, for example, companies with very high debt loads will have lower price to sale multiples than companies with low debt loads. The alternative, which is a lot easier, is to value a company and ignore what the debt is. Because what you have to do when you're doing the debt included is if you have a company in an industry where it doesn't have the same amount of debt that's standard in that industry, what you have to do is adjust for it. So you got to put more debt in the balance sheet. You got to increase the debt expense. It's a real nightmare to apply that method. It's a lot easier to value a company independent of what its capital structure is, because when a buyer comes in, some buyers might finance with a lot of equity. Some other buyers might be able to get to finance with a lot more debt. Not all buyers are able to go to a bank and get a big loan, so they might have to put in more equity. So the simpler way is what's called the unlevered approach. And so what you do in that unlevered approach is you come up with a value of the company using a multiple that's independent of the capital structure. So by far the most common there is the enterprise to value to EBITDA multiple. So what you do is you take the EBITDA of a company, you multiply it by its enterprise to EBITDA multiple. That gives you the enterprise value of the company. The enterprise value of the company, remember, is the equity and the debt. So if you want to know what is the equity of the company worth, what you do is you take the EBITDA of the company, you multiply by the enterprise value to EBITDA multiple, you get an enterprise value, and then what you do is you subtract the debt, and you're left with what is the equity worth. So let me show you that example. So the enterprise value of that business there is going to be the EBIT to EBITDA multiple times what the EBITDA of the company is. So in this case, it's 3.5 times 100,000. So the whole company is worth 350,000. So that's the 350,000 is the value of the equity and the debt put together. The enterprise value. So if you want to know what is the value of the equity, what you do is you take the enterprise value. So remember that enterprise value is the equity plus the debt. And so if you know the enterprise value and the debt, you want to know what is the value of the equity. You just take what the whole company is worth, and then you subtract the debt. So in this case, the whole company is worth 350,000. And if you have debt of 75,000, then the equity, so the shares of that company are worth 275. Alright, so that's it. I'll see you at the final exam Saturday, December 15th. I'm available by email if you want to meet with me. You can come meet me at the office on Riverside, or we can arrange to come to meet at my office at Carleton. The problem with the Carleton office is that I share it with like 10 other people, so most of the time I go there, there's somebody else there. So if you want to come, I'll be available by email. But if you want to have a one-on-one in-person session, it's easy to get to the Sunbelt office, and we have very comfortable boardrooms. A lot more comfortable than the tiny little office they give me at Carleton.